Hey friend, welcome back to the Live Off Rents show where we bring in real estate and other financial experts to help you build passive income, create your dream lifestyle, reach financial independence, all those good things that we all want. As always, I'm your host, Brian Davis, co-founder of Spark Rental, and I'm in this journey with you in the trenches every month in our investment club, vetting deals together, putting my own money in real estate deals alongside you. So, on that note, I am really excited to introduce today's guest. He is a syndicator himself. Agostino Pintus is the founder and CEO of Bulletproof Cashflow, where he applies nearly 2 decades of real estate experience to sourcing, negotiating, and acquiring commercial properties. So, Agostino, welcome to the show.
Hey, thanks for inviting me, man. Greatly appreciate it.
Absolutely. So, we usually start by just asking how you got into real estate in the first place, and then what's changed since
Sure.
then.
A lot's changed. I can tell you that. Let's
I'm
cut to the
sure. I
chase there,
believe
right?
it.
I actually used to work in corporate. I used to work in corporate. I made it all the way up, got into the lower ranks in technology. Used to do a lot of. I'm sure you find a lot of tech guys that are in this business.
We do.
And yeah, got to the C level. And the one thing about working in corporate, there's good things and bad things. The good thing is about working in corporate is that you learn how to run a business, you learn how to run a company, and you learn how to manage people and lead people, which are two different things.
Oh yeah.
And but the downside is that if you're an entrepreneur at heart, and they don't, and corporate doesn't appreciate those sorts of people, not always. You tend to end up getting riffed a lot, or you're just getting removed or whatever, right? And that happened a lot to me. I've always been an entrepreneur since I was a kid, and I would say that once the very last time when I made the decision to really hone my focus and do real estate, at that point, which is probably about 7 years ago, I had already built up a small real estate portfolio of single families and small multifamily deals. And I'm like, I got fired yet again from some other company because the guy who hired me, the president of the company who hired me, I was a vice president or CIO, vice president CIO. The guy who hired me left, and the new guy comes in, wants me gone because he wants to bring in his VP and CIO, right?
Right.
Chief Information Officer. So here I am again. The higher up you go, the bigger the target on your back, right? And I'm like, how many more times am I going to do this? How many more times am I going to put the fate of my hands, or the fate of the fate of my family in the hands of someone that doesn't like me? How many more times can you possibly do that, right?
And often
So
someone who doesn't even know you, in that
it doesn't
case,
even know
when
me, right?
someone
It
when
doesn't
someone new
even
comes
know
in.
me. Exactly. I had three. I talked to the guy 4 times total, and had no appreciation for everything that I've done the 2 years prior. It's just you're out the door, get your box and get out. I'm like, you know what? I'm not doing this anymore. And I reflected on my life, and I realized that, no matter what happened, real estate was always there for me. I mean, even though it was very, very small scale, it was always there. So once I focused my efforts and decided to really focus on doing much larger deals, bigger deals, I started bringing that into focus. So I picked a market, Cleveland, Ohio, which was the market that I chose because I saw that there was still plenty of growth. The rent to the per unit cost, where the ratio was just so far out that I'm like, oh my God, that's the place to buy right now. And we're talking 7 years ago.
Sure.
So I
Yeah,
got
the
in.
Midwest has definitely been discovered since then.
Oh yeah, yeah. But back then, people were wild all about the Carolinas and to a lesser extent, Florida. All right, and some Texas stuff. All the Florida and Texas stuff didn't really happen till the 2020 election and all that stuff that happened, right? With everything related to that. That all happened then. But we're talking like 2017. 2016, 17, 18, like it was mostly the Carolinas that was getting a lot of static. No one was paying attention to the Midwest, so I made the move out here and got to studying the market, learning the players. Building a reputation for being a closer, and ended up becoming one of the top 3 buyers in Northeast Ohio at one point. And it's like it's been a phenomenal journey so far. Phenomenal journey so far. It's just been crazy. crazy, the things that we've done, So, but I started, underwriting deals, bringing in people to help me take deals down, and making great things happen. So, but it took a hardcore commitment to doing the deal. Like I remember telling my girlfriend at the time, who's now my wife, I said to her, I said, I'm going to do one last thing. I'm going to work for someone else as a consultant. One last time. After that, I'm never doing it again. I made myself a promise, made her a promise, and that's the level of commitment that is required to, at least for me anyway, to make that shift. Because if someone will tell you a real estate business is so easy, oh yeah, anybody can do it. No,
It is
it's
not.
not. It's not easy. It's extremely difficult, especially when you're starting out. But once you get started and you build a track record, it becomes much easier,
Yeah, so many things that you said jumped out at me. One is that helpless feeling of being fired. I've been there, and it sucks, right? I mean, you feel so helpless in that moment, um, and you reach out to, or you see the appeal in diversifying your income streams and having multiple streams of income that are all flowing in regardless of what's going on with your W-2 job or lack thereof, right?
Yeah.
And I loved how you said you made the decision to become an entrepreneur and to launch your own business. But of course, that takes money, right? So you said, okay, I'm going to go out and I'm going to get some active work, working for someone else, but that is a means to an end. That's specifically to fund this new business venture.
Exactly.
It is not a job. It's not a, it's not my future. It's a means to a very specific end.
Yeah.
When my partner and I launched Spark Rental, it takes a lot longer to get things off the ground than you think it will, and it takes more money, right? So, what do we do to extend the runway? I went out and I did some freelance writing work. My partner went out and did some realtor work, and we were able to bridge that gap. But it takes money to start a business. It takes time to get that business off the ground and get it profitable. So it makes total sense, the approach that you took there. So tell us about your first syndication deal. If we have anyone in the audience who, maybe they've done a couple single family or small multifamily deals, they're intrigued by the idea of becoming a syndicator, doing a first syndication deal. How did yours go? What were the challenges? What went wrong? Tell us about that first deal.
Well, Brian, I'm going to preface what I'm about to say with, don't do what I'm about to tell you. So this is an opposite of what you should totally do, right? So the very first deal that I did was one that I used my own money on, because I felt that I had to do my own deal to build credibility to the market. And it was a small deal. It was only it was an 11 unit. And that had another 12th unit that was already started. So I built out the 12th unit, and it was a nice little deal, and I did all that on my own money, all that fun stuff. And then I'm like, okay, so now I got to do the next one. It's going to be a syndication. And I found on LoopNet, of all places, the place where deals go to die. Right, we all know that. That's the graveyard. The deal graveyard is on LoopNet. And the property manager that I hired for that first deal had a listing, because there was also a broker, for another deal that happened to be in a tertiary market. So this is why I now don't do deals in tertiary markets. There's certain deals that I've done in tertiary markets. That means tertiary markets are markets that have, what is it? I think it's 200,000 population, right? Low population, right? So I won't even do deals in those markets anymore, because of this experience, right? Tertiary market, I call up the broker, who I already knew because he was already managing one of my other properties, and I asked him about the deal. I said, it was a 56 unit deal. And I asked him, I said, hey, is this deal, tell me about this deal. Is it still well, how much was it? Was it I don't know, 1.4 million or something like that? It wasn't that much. I forget how much it was. I don't remember. It wasn't super expensive, right? And he said, I go, it's been sitting on the market here for a long time. What's the deal with it? Because the contract just got canceled. Do you want to buy it? I'm like, sure. What's the price? Gives him the price. Great. Send a PSA over. I'm going to sign it right now. I didn't even look at it. Didn't even
Wow.
look at it. Had no idea. Like all I'm doing is underwriting deals all day long. I'm underwriting deals. I was probably underwriting 100 deals a day all over the country. So I knew like what the price to rent ratio should be. I knew where the expenses should be just based off my, and this is, again, at that point, I was probably at underwritten, I don't know, 1,000 deals at that point. I underwrote a lot of deals, man. And probably more than 1,000 deals. What am I thinking about? Yeah, I was underwriting a lot of deals. I was learning as much as I could, on my own, and listening to a lot of podcasts and stuff like that to learn how to underwrite deals. So great. I locked up this deal, and I'm like, I need the money. Oh my God, I better go raise the capital. So how many phone calls it took me to raise the money for that deal?
I'm guessing a lot.
Two.
Really?
Two
Just
phone
two?
calls. The first one was a lady I had on my show, on the Bulletproof Cashflow show. I call her up and said, hey, I told her about the deal. She told me to, in so many words, to screw off. I'm like, wow, I was not anticipating that response from her. I don't know what she woke up on the wrong side of the bed. It was a bizarre response. The second lady, told her about the deal. She loved it. She flew out. She saw it. We went through the whole business plan, and it's like, oh my God, this is a great deal. I'm like, I know it is. Like, it's very unusual to see anything like this on LoopNet, that kind of thing. So we raised the money in 22 hours, all the money needed for this deal, plus renovation, everything else like that. 22 hours,
Wow.
right? Raised all the money, and then we shut it down and got the deal closed. Now, on the lending side of things, she came from out of state, and I didn't have the lending relationships at the time. So a big mistake there was using a guy that she knew, even though it was my deal, and her guy was also in Seattle or something, who knows nothing about this market, and he's going to a regular old bank to do this deal, right? And a deal, like, there's certain things you have to understand about underwriting deals, okay? You don't just, there's banks like, US Bank or Chase or BFA, not so much Chase or BFA. They used to do commercial. They don't really do commercial anymore. They say they do, they really don't. Just word of caution for people out in TV land there. They don't do those deals. They say they do, they don't. US Bank barely does those deals, in my opinion. But some banks will say they do these types of multifamily deals. They may do institutional style deals, but not every deal. This is not an institutional style deal. It's a C-class warehouse or workforce housing type situation here. That's what this is. All right. The lender was leading us on to the very end and then backed out. Surprise, right? So big mistake there was using an out-of-state guy that had no relationships, that even understood the deal itself. Stupid. You don't do that. You only use lenders that have experience working in the market. Like, not just experience, they've shut down other deals in the market. I'll explain why in a second. So we did that. I ended up getting the deal shut down. We went through our plan to improve the property, and we held on to it for, I think it was 3 years. We got the investors their money back, gave them a little bump, made an exit, sold it to a group out from like Turkey or something, and they run it now. So some a whole lot of learning lessons there. Tertiary markets, that was one. I bought a bunch of deals in tertiary markets. I'll never do one again. They're way harder to move, way harder to sell. When you're walking into a deal, you have to know that you can unload it. That's the first thing I learned from doing houses, from single family homes. Believe it or not, I learned that from single family homes. If you have to think about what the exit's going to be, right?
Absolutely.
You have to think about that. What's the exit? Who's going to buy this thing from me? That's the very first question. If nobody's lining up to buy that asset, it's probably a bad asset. If there's no line out the door to buy that property that you want to buy, chances are it's a bad deal.
Right. What does everyone else know that I don't know?
Exactly. But someone know, like, there's deals that I've looked at, and I speak to a previous owner, and the previous owner says, "Hey, did they disclose to you that property, it was like the 200 unit apartment complex? Did they disclose that the apartment complex was built on a what is it, on a trash heap? What is it?
Oh, landfill.
Landfill. Yeah, they never disclosed that.
That's a
That's
material
kind of,
fact. Like
that's a material fact. That's kind of
yeah.
important, right? Yeah, it was
By law,
built
they
on a
have to
landfill.
disclose that.
Go figure, right? But I just happened to run into, well, the previous owner was friends with an attorney friend of mine, and he just, we were looking at the deal, and he's like, "Oh, did they tell you that?" I'm like, "No, but thanks for the information. I
Yeah.
appreciate it." It's like that this deal wasn't built on a landfill or anything, but it's like, so yeah, that you have to know that who's gonna buy the asset. Don't use out of state people to like source the debt. And if you do use out of state guys, make sure they're familiar with the market. Um, like the guys I use are all out of state guys. Well, there's only a handful of people that I use really. Have very, very close relationships with these folks, but they know the market. Like they know the market like the back of their hand because they've already transacted numerous times in this market. Like they're experts at the Cleveland market. The reason why this is so important, okay? Another thing I learned in this business is that much like football or basketball or baseball, whatever the sport, you have a team of people. And if your team is deficient, or one individual is deficient and they drop the ball, they screw up, they get to go home and go have dinner with their family and go live their life or whatever. But you, Brian, you're the guy that took the risk. You're the guy with the earnest money that's about to go hard and in 5 days. And you're the one that has to deal with all the fallout, including the broker saying, "Brian, why didn't your guy perform?" Waving his
Right.
fist at you. You're the coach. You're the one that gets punished, right? That's why having a strong team matters, right? You have to have a strong team. You have to know how to build the team. You have to have people that can pull it off and not feed you a line of crap. This guy, I learned, this friend of this partner that I had he's full of crap. "Oh, no, don't worry about it." When I was telling him these guys aren't closing. I'm getting the runaround. "Oh no, don't worry about that. Don't worry about that." Well, I was right to worry about it. You know, I ended up having to bring in my guy to get it shut down. But it didn't have to be that difficult. It didn't have to be that difficult.
Yeah, real estate investing is definitely a team sport. That's a recurring theme that my partner Denny and I come back to again and again. And
Yep.
when we vet deals as an investment club, a lot of our questions for the syndicator, for the sponsor, revolve around team, right? Like, who is the lead sponsor on this deal, and what's their experience level, what's their track record? If you're just a capital raiser for a deal, then it doesn't really matter what your track record is. It's the person who's actually going to be managing the asset. Like, who is going to be managing the property, and what's your relationship and history with them? Who's going to be doing the renovations, right? Like, is it in-house? Is it contracted out? Either way, what's your history working with them? Yeah. So vetting the team behind each component of putting a deal together, so important. So
Yeah.
I'm curious to hear about some of the risks that you see in today's market. It's obviously been a challenging and choppy market over the last year or two in commercial real estate. So how are you looking at risk today? And maybe what are some of the risks that you're seeing in the market today that maybe not enough people are talking about?
Well, the same risks that I saw back when I really stopped buying multifamily, I'd say 21. And so it's been a few years at this point, before, like, as far as multifamily, we bought other stuff, but not multifamily. Where other people continue to buy stuff that made no sense to me at all. I don't understand how the hell they're getting away with it. And people overpaying for stuff because some guru says so. That's one thing, overpaying for deals. Or they don't have the good lending set up either today or what the exit's going to look like, right? The exit is unknown. That's a huge risk. Now that's nothing really new per se, but technically speaking, if you're sticking to like a market like Cleveland, for instance, right? This is a cash flow market. If you're going to be an investor in a market, in a deal, okay, you're investing in the deal, you're investing in the syndicator, you're investing in the market, Okay. They better know what it is they're investing in. This is a cash flow market. What does that mean? If someone's doing their job properly, it's just going to give you a nice steady cash flow. Maybe you get a big lift, maybe, but you're going to get a nice steady stream of cash flow. If you're going to be in a place like New York City, which I would never recommend, but if you're going to be in a place like that, that's an appreciating market. Los Angeles is an appreciating market. Miami used to be a cash flow market, but it's become an appreciating market, okay? Because there's demand. Demand is the driver. But if that demand wavers, you're screwed. As an investor, if in New York, they decide that they're going to change the rules and no longer make it advantageous for investors to buy deals, it's going to change the market, right? Where a place like Cleveland, a place like the Midwest, I think we talked about this earlier in the green room maybe, this market usually performs very, very steady. We don't have the wild swings of all the crazy stuff you hear about in the news. It's fairly consistent. If you're going to be an investor in a market like that, you're not going to make the giant leaps, but you're also taking a lower risk, right? Understanding what that is, understanding what you're investing in is huge. What was happening, in my opinion, is a lot of guys were using the greater sucker theory to buy multifamily, and they still do it today, in my opinion. They're still doing the greater sucker theory. And what's that? That means overpaying for deals today and then hoping and praying that some greater sucker is going to come around in 18 months and overpay more money for that same deal.
Speculation, not investing.
Yeah. You call it speculation. I call it greater sucker. It's the same thing, right?
Yeah.
Try to find another sucker to overpay for it. And speculation is not investing. Speculation is gambling.
Right.
You're better off going to Vegas or something to do that. And I would say in Texas it happens a lot. Look, we have a mastermind, and we see a lot of deals. A lot of our students bring deals from Texas, and I mean, they already know the deal doesn't pencil. They as soon as I don't have to tell them, they already know it doesn't pencil. And it's like we review it anyway and try to find the deficiencies as to why it doesn't pencil, right? And obviously, it always leads to the cost of the asset, but it's because the guy who bought it overpaid for it, and they have no other choice. And there's no way that you can ever make a deal like that work unless you're putting down a whole bunch of money, and then now you're taking on the risk for it.
Right.
Why would you do that? In Florida, for instance, and you mentioned this too earlier, and maybe this was also in the green room, insurance and taxes,
yep.
Right? Those two things, insurance primarily in places like Florida.
Oh yeah.
I mean, deals aren't even palatable anymore. It's ridiculous. And
oh yeah, we've seen insurance premiums double in some cases.
Yeah, it's crazy. And the thing is that it's a case where insurance, you always underwrote for insurance, but now it's like you have to also understand what insurance is going to be like for today, and then they say the next 2 or 3 years. You have to ask your broker, hey, what's insurance going to be like in the next 24 months, 48 months? I mean, my insurance guy is telling me that we're probably going to have a 25% increase for the next 12 months. 25% increase. Why is that?
That can put a deal's cash flow underwater.
Yeah, exactly. All your NOI is completely gone. But why? The other question is to ask, why? Why is that? The why is because right now, in this economic cycle that we're in currently, people are losing their shirts, okay? What's happening? Oh, a lot of fraud taking place out there, right? What do I mean by fraud? Well, a building magically catches fire, or somehow something happens to a property, and then next thing you know, the insurance company's putting out cash here and there and everywhere, right? A lot of that stuff's taking place. Whenever there's an economic downturn, insurance always goes up. It's and between that and the value of the dollar going down, right? Because we know from what's happened since 2020 and even through to today, we're printing off all this cash. And we're sending it away. We're sending it overseas. We're sending it to Ukraine. We're sending it to all over the country, all over the globe. And the buying power of the dollar continues to go down too. So these insurance companies know that in 24 months, it's going to cost more money, more dollars to pay for that guy to fix whatever is broken that maybe it is even broken today, but they're going to need more money to cover whatever is going to be in the future, right? There's all kinds of things like that take place. So insurance is now a very real thing. Taxes, I found with many municipalities, they're willing to negotiate taxes, not make them go away completely, but maybe they'll put you on some sort of payment plan or something like that. You have to be prepared and willing to do that. A lot of syndicators got caught with their pants down because they did not plan for that. And it's very hard to plan for it too, because sometimes they get cold cocked. Like they don't even know that's going to happen.
Well, that's something we've seen that over the last couple of years, where property tax assessments, went through the roof along with values, and then in many markets, property values have gone down over the last year or so, but property tax assessments have not gone down, right? You're still paying for those peak level property tax assessments and property tax bills. So you mentioned that you are no longer investing in multifamily properties. What types of properties are you investing in these days?
Well, two things. Some of you said it a second ago. I want to address that too. Yes, the tax man is getting you for the higher amount, but what we do is we hire attorneys to come in and fight it, right? So the attorney will come in and fight the higher tax rate. So hopefully, if you're in any deals right now, or maybe you're invested in deals, hopefully your sponsor or you are getting a CPA, tax attorney type person to go and fight those taxes for you. Get someone that's extremely aggressive and very well connected with the city and the municipality. Okay, don't just get anybody. You have to get someone that's connected. Like the guys I use, they are they're lobbyists, for instance, right? They know the mayors, they know the people that work at City Hall, all that stuff. So those are the types of people you want to talk to. Those are the people you want to talk to, right?
No, that makes sense. Well, Agostino, I want to be mindful of your time here, but tell us where can people connect with you if they want to invest, and what types of projects are you doing these days?
Sure. So right now, if you want to invest, if you go to realtydynamics.co or rdyne.com, that's the best place to just get more information about what we do. Bulletproofcashflow.com will get you to the same place too. I would say that right now, these days, there's still a need for housing. We're still doing development, right? So it's all multifamily development, but there's only certain markets that I'm looking at, and there's certain deals that I'm looking at. Here in Cleveland, for instance, there's two big things. There's opportunity zone, and there's tax credits, right? And there's one more actually. There's tax abatement as well, right? So I could build a deal here, or I could build a deal in South Carolina. The cost is about the same, but the cherry over here in Cleveland is the fact they have all these three things that bring money back into the deal, so it reduces the overall cost, right? So I know it's Cleveland, but you know what? If the rents are comparable and you're paying for the same product, why wouldn't you just do it here then, right? So development these days is very big for us. Net lease is still very big for us. I think what we're going to end up eventually doing is a fund of our own, so we can go ahead and help other people get into their own deals too. So that's coming. We're a little ways away from that, but that's going to be a thing we're going to be focused on as well. So, and I'm not doing multifamily because I'm mad at multifamily. I haven't done multifamily because if the deals stop making sense, I just won't do them. That's as simple as that. The deal has to make sense. And
no
there's certain
the numbers have to work.
The numbers have to work, because there's guys out there that'll do a deal and they'll only do it because they get paid to do the deal, and they need to get that kill because they need their $300,000 fee, and then that's it. So I don't operate that way. I just don't do it. If it's a bad deal, I'm not going to do the deal. It's unethical to do that. That's just how I work. If other guys do it, that's perfectly fine. They can go ahead and do that. I'm not mad at it. I'm only going to do deals that make sense. I don't like doing stupid deals, Well, so yeah, that's the long and short of it.
Couldn't agree more. And Agostino, thank you so much for joining us today. This was a lot of fun.
Yeah, thanks. Thanks for having me on. Appreciate it.
Absolutely. And guys, if you enjoy these conversations that we have, please rate, review the show. Makes a world of difference to us. And we will catch you same place, same time next week. We'll see you then. Bye now.
Like the idea of diversifying into real estate, but don't want the headaches of being a landlord? Enter passive real estate syndications. You buy fractional ownership in apartment complexes and other large-scale properties, earn your share of rental income and your share of the profits when the property sells. In fact, most of the syndicators we've invested with have averaged returns over 20% per year. You even get full tax benefits, including accelerated depreciation. Even as you collect distributions in real life, you often report a loss on your tax return. So why doesn't everyone invest in real estate syndications? First, you typically need to know the syndicator to invest, and the minimum investment for each property is high, usually $50,000 to $100,000. That's a lot of money for a single investment, which is precisely why we formed an investment club to pool funds and invest together. Every month, we propose a new deal in the co-investing club and vet it together on a group call with the syndicator. Each deal is purely optional. Pass or invest as you like. As for us, we invest our personal money alongside you in every single deal. If you want to invest like the 1% without actually being a 1%er, join Spark Rentals Co-Investing Club. Email us at support@sparkrental.com with questions, and we look forward to investing alongside you.